You might be wondering about the price decrease of Nvidia stock following its earnings release. Revenue surged by 122%, profits soared by more than that, and management signaled that demand for its products remains ahead of supply. I read the entire earnings results from Nvidia, the financial statements, and the conference call with analysts. The conference call will be the focus of this video. Specifically, what the CFO said about the company's progress on several critical categories, including revenue growth, customer concentration, and the prospects for the future. So join me and let's learn more about Nvidia's phenomenal business and understand why the stock price fluctuated in response to these developments. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So Nvidia CFO Colette Kress highlighted that revenue came in at $30 billion, and that was up 15% from the previous quarter and 122% year over year, and well above what they thought they would deliver, which was $28 billion. So Nvidia management thought they were going to deliver $28 billion. They actually delivered $30 billion. And so the number was much better than expected. This is one reason why investors are surprised that Nvidia's stock price is down on the day after the company announced the earnings results. Revenue was much better, and therefore the forecast was much better. And so investors are a little bit curious on what's causing the price to decline. Cloud service providers represented roughly 45% of data center revenue. 45%. That means companies like Amazon, Microsoft, and Alphabet and Meta Platforms were the vast majority, or not the vast majority, but a meaningful percentage of Nvidia's revenue for the quarter. And that could be one reason why the stock price is down. The company's concentration risk increased from the previous quarter. If I shared with you this same data from the previous quarter, you will see that this was roughly 40% in the previous quarter, and it now moved up to 45%. Even at 40%, investors were concerned about the concentration risk at these hyperscalers, and now at 45%, investors have become even more concerned about the concentration risk because they're wondering how much longer can Microsoft and Alphabet and Meta Platforms and Amazon, how much longer can they spend tens of billions of dollars on capital expenditures building out these AI data centers? Will they reach a point where they say, all right, that's enough, we don't need any more, and all of a sudden, does that mean Nvidia's revenue is going to sharply slow down? Those are the question marks that are concerning investors. The CFO goes on to say that customers continue to accelerate their Hopper architecture purchases while gearing up to adopt Blackwell, which is the next generation technology. Hopper is its current generation technology. Importantly, Hopper is a combination of not just the GPU, but all of the products that NVIDIA offers, incorporated all together to work together as a system as what it calls an AI factory. And so the Hopper architecture is the current generation of that AI factory. Blackwell is its next generation that's going out right now, sampling and shipping out in larger quantities in the fourth quarter, and then starting to gain use and stand up in the first quarter of its next fiscal year. The CFO saying that the next generation models will require 10 to 20x more compute to train with significantly more data. This is in reference to large language models. And this trend is expected to continue. So that's great news for demand for NVIDIA's products going forward. Is these large language models will require more training and they'll require more computing power, and NVIDIA has over 80% market share in this specific use case. And so if demand because of this use case continues accelerating, Nvidia is in an excellent position to continue benefiting from that growth. Interestingly, developers desire Nvidia's rich ecosystem and availability in every cloud. Developers and Nvidia's rich ecosystem are one of the main reasons why Nvidia's products have such a large market share. It's not just that the GPU is so much better than any other GPU in the market, which it is. It's better than any other GPU across a variety of end use cases. It outperforms AMD's GPUs and custom-made GPUs and TPUs and other chips developed by other companies. Nvidia's is the best for use in developing and inferencing for large language models and other AI use cases. But on top of that, Nvidia has a rich ecosystem that makes it easier for developers to utilize. And so that end use case is something on top of just the power, the performance of the GPU for Nvidia. Now, Nvidia's H200 platform began ramping in the second quarter. This is the platform that's incorporated into the Blackwell technology, and it's going to start shipping to large consumer service providers and consumer internet and enterprise companies. The Nvidia H200 will offer over 40% more memory bandwidth compared to the previous generation H100. Companies are jumping over themselves to get access to this next generation Nvidia technology. Management said that demand for this is well ahead of its supply, and that's likely to remain that way well into next year. So for this year and the quantity they have available to ship out in 2024, the demand for those products are already accounted for, and it's well ahead of what Nvidia has available. Management said that's likely to be the case next year as well. So for at least a year, demand for this technology is going to outpace supply. And that's great news for Nvidia stock investors, where its technology is so highly demanded that it's well in excess of supply, because that will allow Nvidia to charge premium prices and have negotiating power with its customers when they go to sell these products. They can ask for things like, well, if you want priority to be on top of our list for this product, you have to not only pay us a high price, but you also have to give us a deposit before we send you the product, or you have to pay us 50% upfront, or whatever Nvidia desires from the companies that want to purchase these technologies, they can ask for, and it's a great likelihood that they'll receive it, because these companies want these products so badly, and they understand that their competition also wants access to these GPUs and the Blackwell technology, that they're willing to overpay, and they're willing to offer better terms just to gain access to these products. So all of which is great news for Nvidia stock investors. Now, to wrap up this video, nearly everything we saw from what the CFO said here was good news for Nvidia stock investors. The only thing that was not great news, or you can argue is bad news, is the increase in customer concentration to those large hyperscalers, going from 45% concentration to 45% concentration on a larger revenue total. So that's the one thing that is a question mark. That's the one thing that increases risk for Nvidia stock investors, because if those hyperscalers all of a sudden need to cut their capital expenditures, then that could be a major slowdown for Nvidia's revenue. Other than that, everything else looked good here from Nvidia's CFO and the explanation to Wall Street investors. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.